Welcome back to my channel, everybody. Thank you for tuning in. And in this video, it's going to be basically an options trading 101 for beginners, just how we can day trade options and what I look for in options to day trade them and how they compare in relationship to the underlying stocks that we do look at. I'm also going to go into ThinkorSwim and break down the options chain a little bit, show you what I look for and how you can read the options in ThinkorSwim, and of course it's the same with any other platform that you're looking at. And like always, I'm going to link my Instagram in the description below. Definitely click that link and follow it. Worth the follow. I post options trading tips, tricks, and I do some daily trade recaps too, and some good psychological lessons as well that every trader should need to know. Link is in the description below. Definitely worth the follow. So going back to the PowerPoint slides, these are the slides that I do have in the course, and I'm just going to briefly go through them a little bit, not into too much detail before we go into ThinkorSwim. So what is exactly an option contract? So an option contract grants the right but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. So what's important here is that you understand what the set price means and what a certain date means, which we're going to break down in a second. And there are two option contracts that you could play for both sides. There's a call option contract or a put option contract. When you're talking about calls, these calls are going to increase in value when the underlying asset increases in price. All options are derivatives, so their pricing gets influenced by another instrument. And in this case, options get influenced by the derivative, which is the stock. As the stock is moving up, your calls are going to move up. Now on the right side, we have puts. So a put is going to increase in value when the underlying asset decreases in price. So think of a put as short selling, or it's a bearish position where you want to long a put when you want the underlying stock to decrease in value. As the stock is moving down, your puts are going to go up in value. Okay, so going back to that definition, an option contract grants the right but not the obligation to buy or sell an underlying asset at a set price. So let's break down set price. When we're talking about a set price, we're talking about the strike price. And a strike price is the price at which the option contract allows the buyer to purchase the underlying stock at. I want you to think of options as a bet. Think of it as a basketball game. So not only are you betting on something that's going to happen in the game, such as how long it's going to take for your team to score, let's say 80 points, you also are betting on, how long it's going to take for that outcome to occur. If you think the Cavaliers in a basketball game are going to score 80 points against the Warriors, then you're not just taking that bet of the points, but you're also betting on when it's going to happen. Is it going to happen in the first quarter? That's less likely to happen. Therefore, you could get option contracts for much cheaper. Is going to happen at the fourth quarter. That's more likely you're going to score 80 points in the in the fourth quarter. So those contracts are going to be more expensive because the bet is going to be more in your favor. So set price is the strike price. Now, certain date down here is the expiration. A certain date, contracts expire. That's when your bet has to fulfill that outcome by. It is the last day the option's valid, and there's three things you could do. You could choose to exercise, you could close the position for a profit, or you could let it expire worthless for a profit or a loss. So with options, you not only have to be right directionally, but you have to be right with a time frame that you're looking at. Or else your bet is going to go to zero, and basically you lost the bet and your investment is going to be gone. But I don't want that to trick you with options, because there are multiple ways you can trade it. Like I said, you hold into maturity and you exercise the contract, which is the most common way for investors, not the way I trade. The way I trade it is point number 2. I trade before the contract expires. Options are derivatives, so they move like a stock and they follow the stock price. If the stock is going up, 10 minutes ago where I bought the contracts, they could be worth $1, $2, $3 more in price, and I could just sell it just like I would with a normal stock. And that's exactly how we trade. So going to the options chain and going to any platform that you're looking at options with, you're going to see a bunch of different contracts you could play. Now, in the middle here, we have the strike price. And the strike price is what I was talking about before, about being its set price, where it allows the contracts, allows the buyer to purchase those contracts for the underlying stock. Now, this is not the way we trade, but knowing the strike prices are important because they are something we call in the money or out of the money. We're going to break that down as well. To the left of this, we have expirations. Now, expirations are that certain date or that time frame that we're looking for before those contracts go to zero. Now, in the money is everything that is purple. Out of the money is everything that is black. What out the money and in the money means is that if you're talking about a call side, and in the money contract means that the stock price, so we're looking at Apple right now, is at 375.68. A strike price that is in the money means the current stock is over the strike price. So look at all these strike prices on the left side. Left side are calls, right side are puts. When we're talking about calls that are in the money, the stock price is above the strike price. So Apple trading at 375.68 means that Apple 370 strikes, Apple 360 strikes are in the money. They are worth more because of the outcome of them staying in the money is much higher, so you have to pay a premium for that bet. When I trade, I do not trade in the money contracts. I only trade at the money or a couple out of the money that have high liquidity. So out of the money for calls, now this is for calls only, out of the money means that the current stock price is going to be below the strike price. So Apple's at 375, the 377.5 calls are out of the money. The 390 strike calls out of the money. Now, that doesn't mean, this is a major point right here for beginners because I know this is a common question. That does not mean that the stock price has to be above the strike price for you to make money. That is not the case. I could buy, let's say in this case, the 400 strike calls, which is $25 away from what the current stock price is. And if the stock goes up $1, $2, whatever, these 400 strike calls that are at $1.08 right now might be worth $1.20 or $1.30. So they're going to go up in value as long as the underlying stock goes up in value. And there are other influences as well, like the Greeks and certain things. That's a whole different topic to talk about. That's going to influence the options price. And when we're talking about options pricing, we're talking about the option premiums. Now, on the put side, it's a little differently. So on the put side, you have in the money still in purple, but what in the money on puts is that the current stock price, 375, is below the strike price. So everything above, or let's just say below in this case, when the stock is below the current strike price, then those are in the money. And out of the money is when the stock is above the strike prices. So I only play out of the money contracts. I do not play in the money really at all. And then you also have to look for liquid contracts. So before we get into liquid contracts, an example of contracts that expire worthless is everything that is out of the money. Let's actually go back to the example that I brought up with the definition of an option contract. So it grants the right, but not the obligation to buy or sell an underlying asset at a set price on or before the certain date. Those are the two important keys. The set price is the strike price, and the certain date is your expiration or the time for you have for your bet to be worth some type of money. So the expiration in this case, like I said, is July 31st, 2020, and everything doesn't matter if you're talking about calls or puts, everything that is out of the money by the time the contracts expire are going to be worthless. They're going to be zero. And everything that is in the money is going to have some value because you could exercise those contracts. Now, that is not the way I trade. The way I trade is very simple. If I am bullish or bearish on a stock, I'm going to put Apple in this case. So let's say I am bullish Apple, just random example, right? And I want to buy calls. So what I'm going to do here is go to the call side, and like just in this case, I'm going to play one out of the money. I'm going to put the option chart here. And now we're talking about calls. So we want the price of the stock to go up for our option contracts to go up in value as well. So let's say we're bullish Apple and we want to buy at the 374 mark, and we sell, hypothetically speaking, at the 376 point, which is about 0.50% on the stock price. It went up $2. Now, instead of buying the stock, we buy the option. Because we're talking about a bullish position, we want the stock of Apple to go up, so we're going to buy calls. In this case, there's two price charts on the left and right. On the left is the option chart, and on the right is the stock chart. They look identical because, like I said, an option is a derivative. It follows exactly to the pricing of another instrument, and in this case, it's Apple stock. So instead of buying the stock at 374, we could have bought it at $6, and then we could have sold it at, I don't know, whatever this high is, at 665. So you don't have to hold these to expiration. You can buy it and, 20 minutes, 30 minutes later, sell it for a profit. We could have bought it at $6 and 30 minutes later could have sold it at 660. So they have the same pricing as basically of a penny stock. And yes, one contract lets you control 100 shares. But you do not have to hold these into expiration for you to make money. These contracts at that point are out of the money, yet they still increased in value because of the underlying stock also increased in value. And also the premiums right here, you have to times it by 100 per contract. So if I buy one contract at $6 and I don't know 50 cents, then it's going to cost me $600, $650, because one contract lets you control basically 100 shares of the stock if they do have value by the time of expiration and you do want to exercise those contracts. So yes, they have the same pricing of like a penny stock. So it's basically a penny stock of a blue chip stock. But you also have to take into consideration there's much more risk with options because your premiums can go to zero. If you trade close to expiration, you let the Greeks get into the way. And also one contract is basically you get to control 100 shares, but you buy and sell it like a normal stock. Buy it at $6, sell it at 660. So I hope this video cleared up a couple of things. If I missed anything, drop a comment in the comments section below. If you want me to make another video about maybe Greeks, about how to make a TD Ameritrade option account, whatever you guys want me to make, I can make a video on. I'm always looking for suggestions. If I missed something in this video, please feel free to let me know. I hope you guys enjoyed it. Subscribe to this video if you learned anything. Drop a like, comment, and definitely follow my Instagram.